All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Wednesday, everybody. Today's April 9th, 2025. Now, look, guys, when I do this show every morning, the idea is I give you a walk through markets and we talk about what's happening in the world. Now, there's a problem this morning. I can't tell you what's happening in the world because I don't know what is happening in the world. Nobody knows what is going on right now. Nobody. Certainly not the people in charge. I have been trying to figure out what has been going on since last night. I was up pretty late yesterday digging into stuff that confused the hell out of me. And I've consumed a lot of opinions. I've read a lot of research, a lot of very informed analysis. I've read a lot of very uninformed analysis over the last few days. The one consensus is nobody really knows what's going on at this moment. So let's take a snapshot of where we're at. All right. In the last couple of days, since the tariffs have been announced, we have had the US dollar has weakened substantially. The price of a barrel of oil has fallen $16 in what, 4 trading days? $16 a barrel lower. So gas is getting cheaper. We're all going to be broke, but at least we'll have cheaper gas. We've got that going on for us. Gold and silver initially sold off, had a little bit of panic. Now they're doing better. Gold and silver up this morning. The S&P 500 has fallen 689 points since the tariff announcement. The Dow has fallen 4,810 points since the announcement. And the NASDAQ leading the way lower, 2,331 points, 13% lower in 4 trading days for the NASDAQ. And I'm telling you guys, all of those things that I just said, all those huge moves don't matter. All right, understand, those are just the knock-on effects. It's the bond market right now that has everybody scratching their heads, and it's the bond market that you need to be worried about. It's the bond market that the Fed needs to be worried about. Everybody says, oh, the Fed's going to turn on the money printer and cut rates to save the stock market. No, the Fed is not worried about the stock market, but you better believe the Fed will drop their sandwich in the middle of lunch and sprint to that computer the second something breaks in the bond market. And that appears to be what is happening right now. Nobody knows what. And it's kind of cliche in FinTwit, the whole something breaks, what broke, something's going to break. Last night, it really looked like something was breaking. Now, again, I just want to emphasize, guys, nobody really knows what's going on here. Even the best minds in finance right now, people whose opinions I really respect, and these guys know their stuff, they just don't know. So let's talk about some possibilities. What could be happening in the bond market right now? And when I say happening in the bond market, guys, the 10-year Treasury yield has risen 63 basis points in the last 3 days. And remember, bond yields rising as bond prices falling. Treasury bonds are selling off like crazy right now. The 30-year Treasury has risen as much as 68 basis points in 3 trading days. Now, understand, this is the safe room, all right? Bonds is where you go for safety. When things get bad in the stock market, as they have gotten recently, you sell stocks and you buy bonds. That's your classic flight to safety, but that's not happening right now. People aren't buying bonds for safety. People are selling bonds in a panic. This does not normally happen. The last time anything like this happened, March of 2020. Oh, it wasn't. What a wonderful time March of 2020 was. So what could be happening? What could be driving this breakdown in the bond market where it is not serving the function it typically does? One pretty popular theory I'm hearing is that it's the Chinese are selling our debt, or maybe Europe is selling our debt to punish Trump for the tariffs. All right, that's plausible. And there's probably a little bit of that going on. The Chinese have actually been selling our debt since about 2015. People don't realize it. They've sold hundreds of billions of dollars of their U.S. treasuries in the last 10 years. I'm sure they're still doing it. I doubt they stopped. But here's the thing. If the Chinese were selling our debt, they would be converting those dollars back into yuan. And so we would see the value of the yuan spiking if the Chinese were dumping U.S. treasuries en masse. We're not seeing that. The Chinese yuan is actually plummeting rapidly. It's falling so fast, we'll talk about this later, that the Chinese central bank is trying to throttle it as it falls. So I really don't think it's China dumping our debt. Plus, they'd be lighting their own banking system on fire if they did that, because Chinese banks need dollars like everybody else. Now, Europe, we're seeing the euro strengthen significantly against the dollar here this morning. It's entirely possible we have money flowing back into Europe, especially as Europe is spending money to rebuild their military after that blow up in the Oval Office. Maybe we got some of that going on this morning. But again, Europe wouldn't do that on purpose because European banks, just as levered, probably more levered as ours are, just as dependent on the dollar and the euro dollar system, they would be blowing themselves up. It'd be like pulling the pin in a grenade in a small room. Dumping U.S. debt in the trade war is the mutual assured destruction of finance. All right. That is like dropping the nuke when you know you're going to be nuking yourself in the process. I really don't think that's what's going on here. Now, another thing I hear going on or being talked about a lot is somebody is blowing up in Japan, the unwind of the yen carry trade. I would say that is a very plausible scenario. Actually, that's one of the front runners for what's going on right now. And if you look at the big move in the bond market last night and the timing of that big move, it supports the theory that it's somebody big going poof in Japan. The bond market hit its lowest point, or the yields hit their highest point just before midnight Eastern time last night, right in the middle of the trading day in Japan. So I'd say that's plausible. Remember that panic on August 5th, the yen carry trade unwinding. The yen is actually strengthening significantly right now. So if the yen carry trade was unwinding, we would be seeing the yen strengthen against the dollar as people sell U.S. stocks, convert to yen. Sell U.S. stocks, then convert those dollars back into yen in order to pay off their debts in Japan. That is highly plausible. All right. So I think right now, Japan probably one of the front runners. Another thing I've heard several people talk about is this big blowout, this increase in yields is just simply rising inflation expectations. Tariffs are going to send prices higher. People have no idea how much higher. Have you freaking seen the numbers being thrown around? Trump put an extra 50% tariffs on Chinese goods yesterday on top of the 54% he announced last week, 104% for anybody who's counting, plus the tariffs that were already there, 113% markup on imports from China. Yo, you guys have any idea what that's going to do to CPI in the short term once those prices hit? Oh my God. By the way, China retaliating 84% tariffs on exports from America today. Congratulations, everybody. Let's just keep throwing out bigger and bigger numbers and see what happens. I'm sure it's going to be great. So obviously, inflation expectations are rising, right? Now, when inflation expectations rise, as we've seen with the Michigan Consumer Index showing rising inflation expectations, people start to demand higher interest rates for making loans because the money's going to be worth less by the time they get paid back. Okay, so rising inflation expectations, maybe that's contributing to the move here, but you don't get 60 basis point moves in 3 days off of inflation expectations. Just not happening. It's probably contributing, but it's not the cause here, not the primary cause. Now, the fourth possibility, and this is the front runner in my opinion, is the blow up of the basis trade. Now, the basis trade is what ultimately forced the Fed to act in March of 2020. It wasn't the decline in stocks. It was hedge funds losing potentially trillions of dollars because of this highly levered bet called the basis trade. And that's where institutions, hedge funds, they'll buy a cash bond and then they will sell a corresponding bond future against that. And typically the net position is zero, right? Because you're long and short on the other side. So they cancel each other out. And what you're doing is you're making a very small difference in the interest rate between those two instruments. That's what they call it. It's basically a carry trade. It's very similar to what's going on with the yen. It's picking up pennies in front of a steamroller, though, because it's very modestly profitable. If you do it big enough, the leverage is up to 100x in these basis trades. But when the trade goes against you, you can get wiped out in the blink of an eye. And that basis trade blowing up is what happened in March of 2020. And if you look at the conditions in the market right now, it highly resembles what happened in March of 2020. So I think the basis trade blowing up, in my opinion, that's probably what's happening. But the thing in Japan also, very likely, it's also possible both are happening. Certainly inflation expectations are contributing, and money leaving the United States might be contributing. All of this stuff might be happening simultaneously. We just don't know. But again, guys, the bond market, I cannot emphasize that enough. This big, complex, spooky thing that nobody really knows how it works. Even the people who run it don't really know how it works. Something is majorly wrong in there because it is not functioning how it's supposed to, how it traditionally does. That flight to safety is not working. There is a panic. Everybody is running out of the bomb shelter. What the hell's going on in the bomb shelter then? Nobody really knows. We got a lot of other news going on this morning, guys. We got Delta Airlines just pulled their guidance this morning. More companies are going to do that. How do you forecast what your business is going to do when there's 113% tariffs that might or might not be applied at some point during the next quarter? You can't. So you're going to see more and more companies are going to do what Delta just did, pull their guidance. Now, this market loves certainty, and they trade based on what forward earnings are expected to do. And since there is no certainty on what forward earnings are, market really doesn't like this. So that's probably going to contribute to this volatility in stocks this morning. We got Microsoft canceled another data center yesterday, this time 3 data center projects in Ohio. Microsoft is going to grow corn on the land that they bought for a data center instead. That's right. We have this whole tech bubble going on simultaneously while this breakdown is happening in the bond market. Tell me, if demand for compute is so insane, like Crazy Eddie's prices, right? If we just can't get enough of this stuff, then why is Microsoft planting corn instead of building another data center? All right. Who had Microsoft planting corn on their 2020s bingo card? I sure as shit didn't. So yeah, we got an AI bubble probably bursting on top of the breakdown in the whole global order. So, there's the cherry on top of this poop Sunday going on this morning. I'm out of breath, and the show is just getting started. Why don't we shrink my big melon of a head and let's see what's going on in markets this morning, shall we? Guys, don't forget that like button for the YouTube algorithm. And if you're new here, hit that subscribe button as well, because we do this one every day. It's normally not so crazy like this, all right? The average days, we still do this. It's more calm. We just go through markets casually, gingerly. We have some fun. Days like today, it's pretty important. So come on back tomorrow. Have your coffee with the melon heads. A lot could happen in 24 hours. Right now, the S&P down 32 points, a modest 32 points lower, 0.66% lower. Look, yesterday we were talking about the big rally that was happening pre-market. The Dow was up over 1,000 points at one point yesterday. And I was warning people, hey, watch out for the leverage. Be careful of these bull traps. And, well, that sell-off lasted until about 11 a.m. tomorrow, and then the market resumed its downward trend. I see nothing on the horizon right now that is going to arrest this trend. Short of everybody just deciding, you know what, this trade war was a bad idea, we're going back to the way it was, I don't see this stopping anytime soon. But there are going to be some big moves along the way, guys. We're going to see these 1,000-point swings in both directions probably for a while here. The Dow, meanwhile, 400 points lower this morning, 1.08% lower, off of its lows from the morning, but still in decline. And the NASDAQ is actually threatening to go positive here. Look at that, down 20 points here, 0.12. The NASDAQ was a little bit, it was a couple hundred points lower this morning, actually threatening to break into green territory. I did not see that one coming. Let's look at what's going on in the indexes around the world. We don't normally do this, but this week we've been doing it. We've got the German DAX is down about 3%. The British FTSE index down 2.75%. The French CAC 40 down about 3.25%. We've got the Spanish index down 2.4. Let's go down a little bit. Let's look at what's going on in Japan. The Nikkei down almost 4% last night, selling off almost 1,300 points. Again, somebody blowing up in Japan is one of the front runners, one of the contenders for WTF is going on in the bond market here. The big sell-off in Japanese stocks, I think, contributes to that. We've also got, look at these Chinese indexes. What a joke this is. The Shanghai index, 1.3% higher. The Shenzhen higher by 1.2. The Hang Seng in Hong Kong, that's up by about 0.75% or 0.2%. Guys, the home team is buying here. That's what that is. When 113% tariffs get put on your multinational exporters, their stocks don't go up. All right, this is the Chinese government is buying stocks. This is talk of stimulus in China is what's driving these higher. I would not expect the rally in Chinese stocks to last here. This is a war of attrition, and nobody will be spared, all right? You're going to have posturing among politicians, and everybody's going to cheer for the home team, and yay, go America, and the Chinese will be like, yay, go China. We're all going to bleed here, guys. This is going to hurt everybody. All right, meanwhile, the DXY, 102.1. That is 87 basis points lower. We've got the dollar weakening here. So what is contributing to the dollar weakening? All right, the two biggest inputs to the calculation, that is the U.S. dollar index, are the euro and the yen, and both of those are strengthening this morning. All right, let's take a look at the yen first. USD JPY, the number of yen it takes to make $1. That's down to 144.7 this morning. All right, remember this chart moving lower. That is the yen strengthening against the dollar. And I've been warning about this for a couple of weeks now. All right. The level that we're at here is exactly the level that we were at during that big panic on August 5th when the yen carry trade was starting to unwind. So this is one of the reasons why I suspect what's happening right now, that the blow up in Japan is one of the likely sources of this bond market turmoil. Now, we've also got a significant move in the yuan. This is the Chinese currency here. All right. Now, look at the yuan. This is moving in the other direction. The yuan is actually weakening substantially against the US dollar right now. It actually broke long-term resistance. We're higher than we were. Let's zoom out on this chart. All right. We are now higher than we were on this chart than we were in September of 2023, the last time the yuan was in free fall, right before the Chinese started supporting their currency, propping up their market because of the collapse of their real estate market. So if the Chinese were selling our debt en masse, if they were just dumping $50 to $100 billion worth of U.S. treasuries, we would see this chart moving in the other direction. That's why I don't think China selling our debt is really the big driver of what's happening in the market today. Now, we did get this one. China's central bank asked state-owned banks to reduce U.S. dollar purchases. Now, this is interesting because when I saw that big move in the yuan yesterday, what I initially thought was the Chinese government is intentionally devaluing their currency in order to make their exports more attractive on the global market to try to offset the tariffs, which would be just a drop in the bucket when you're comparing it to 113% tariffs. But it looks like China is actually trying to control the decline of their currency here. China's central bank has recently directed state-owned banks to curb U.S. dollar purchases as part of its ongoing efforts to manage yuan depreciation amid the escalating U.S.-China trade tensions. The People's Bank of China is actually taking active steps right now to stabilize the Forex market and prevent any further weakness in the Chinese currency. So the China's central bank, they're not actually weakening the yuan on purpose. If they are, they're doing it very carefully. They're letting it weaken slowly. They don't want any big sudden moves in the yuan. All right, also going on in the Forex market this morning, you've got the euro is strengthening significantly against the dollar. This is USD EUR, the number of euros it takes to make $1. That chart is also moving much lower here. Big move this morning. It's now at about 90 or 0.9 euros to the dollar. If we zoom out here, that's lower than we've been since about September of last year. And I would add, guys, that this all began with that blow up in the Oval Office between Vance and Trump and Zelensky. At that point, that's kind of one of those moments where the global order started to break down. The idea that the U.S. military would always be there to defend Europe kind of was thrown into chaos with that blow up in the White House. For better or worse, regardless of your opinion on the situation, the fact is that is what began this cascade downward in the USD EUR chart as Europe decided, all right, we are going to have to print money probably and spend a ton of it to build our own army, because the idea that the United States is automatically going to come to the defense of Europe, probably not a safe bet moving forward. So this breakdown in the established global order of the last 50 years, it actually started before the tariff announcement. Looking over at the bond market here, guys, and again, this is something you worry about. It's been all over the place. We'll look at the hourly charts in a minute here. But right now, we've got the 30-year Treasury up another 12 basis points here, 4.835. Remember, this is a sell-off in bonds. If the yields are moving higher, the prices are moving lower. Bonds are not doing what they're supposed to when markets are down. The 10-year, 4.400. That's up another 14 basis points this morning. The 2-year, 3.763. That's up only 2.5 points. And the 1 month is actually down a fraction of a point at 4.32. So the move is all happening at the long end of the yield curve. That's where we're seeing these big moves in the bond market. And that's supposed to be the deepest, most liquid market in the world. That's supposed to be the hardest market in the world to swing like this. And right now, it's one of the most volatile things anywhere. Now, let's take a look at this chart so you can kind of see here. This is the 10-year yield. We're looking at daily candles right now. And look, we were all saying it, self-included last week after the tariff announcement. Look, Bessent is getting the lower rates that he wanted. There we go. Interest rates are heading lower. And then something happened Monday morning, and these rates just went, nope, right back up they went. All right, so whatever changed Monday morning, all of a sudden somebody started getting in trouble. The liquidations, the margin calls started. and the bond market has been going in the opposite direction. Now, I want to set this to, like, let's say 30-minute candles here, and I want to show you what happened last night. This is one of the reasons why I think it may have been somebody in Japan last night. Let's see, where are we at here? The times are all over the place. No, sorry. I want 30-minute candles. TradingView not doing what it's supposed to here. All right, so TradingView is acting up. By the way, this happens during volatility. The charts have been kind of wonky. But these are these are 30-minute candles now. This was around midnight last night. I don't know why the x-axis isn't updating here. But you could see the big move in the bond market was happening last night while Japan was open. And then I don't know what this is. What is this sudden decline, this abrupt reversal that we had right around midnight last night? Did the Fed extend some kind of big swap line to a Japanese bank to bail them out? I really don't know what happened. I think maybe we'll find out in the days ahead. But this chart and the fact that the big move happened during Japanese trading hours last night is one of the reasons why I think that theory of the yen carry trade has a little more credibility here. By the way, same thing happening in the 30-year treasury. All right, look, the tariffs were announced. These are back to daily candles. They started moving lower, and then all of a sudden, wham, up we go. Something started to break Monday in the bond market here. And again, when we go to these 30-minute candles, once again, the x-axis doesn't want to update quite so well, but it was right around midnight last night that we saw the abrupt reversal in the bond market in the 30-year treasury. Whatever happened, I don't know. It looks like intervention. It looks like some central bank somewhere, maybe swap lines. I don't know what it was, but it looks like somebody intervened. And whatever it was, look at this big red candle all of a sudden forming right now. So that intervention, it may be happening again here. Let's just put it that way. I don't know what's going on. The yields in the 30-year right now is dropping incredibly fast. Let's switch this over to 1-minute candles. Something happened right after I went live, guys. I don't know what it was, but as soon as 9 a.m. hit, look at this big decline that just started in the 30-year yield. I don't know. Who's got deep enough pockets to move the 30-year treasury market that fast in a span of a couple of minutes? Not many. So that's interesting. That's actually playing out in real time here. I didn't expect that to happen. All right, let's look at what's going on in the commodities board here, shall we? Gold right now up $78, 2.6% higher for gold. All right, the treasury market maybe not behaving like a safe haven right now, but the gold market is. We had some panic in gold late last week. We had gold sold off about $150 in 2 days. And then ever since then, it has reversed, and gold has actually been doing pretty well this week. Silver's along for the ride. Silver's up 63 cents, $30.45 for spot silver, up by 2.15%. I like the shiny. We've got coppers even higher this morning. What's Dr. Copper telling us? We're positive here. $4.21 for copper futures, up by 1.74%. Platinum is higher by 0.2%. Palladium is higher by a fraction of a percent. Look at crude oil, though, guys. $4 lower this morning. WTI crude futures at $57.15, down another $2.45. It's off the lows of the morning here. But let's look at this chart here. Look at the move in crude oil. We're looking at daily candles here, and look at what's happened since Wednesday. All right. You telling me that the tariff announcement wasn't a shock to the world and that we're not going to see a slowdown in global trade? Look at what the oil market is telling us. When's the last time we saw a move that fast, that rapid in the oil market? And guys, I think oil is going lower because the slowdown in trade right now, we're just talking about what might happen. It hasn't even started yet. So at the very least, hey, maybe gasoline's going to get a little cheaper. So we got that going for us. Bitcoin continues to get slammed this morning, $76,736. It's actually a little bit positive for the morning. The slam, I guess, happened mostly yesterday. But the technical breakdown, guys, I was warning about this for a couple of weeks as we were hugging that 200-day moving average. I kept saying, guys, this chart for Bitcoin looks really ugly. There's a breakdown on the horizon. And, well, there we go. We have been breaking down ever since. Bitcoin is a risk asset. There's a lot of people that are over leveraged. Keep an eye on Michael Saylor, man. He borrowed billions of dollars to buy Bitcoin, and the price of Bitcoin has fallen sharply ever since. If Michael Saylor getting liquidated, who knows what would happen to Bitcoin in that event. All right, let's talk about what's going on here. Bonds crater, 10-year yield spikes briefly above 4.5% in confounding move that's worrying Wall Street. And that's the thing right there. Confounding move that's worrying Wall Street. Everybody is worried. Everybody has ideas about what's going on, but nobody really knows what it is. The bond market, not a plunging stock market, is the talk of Wall Street, with prices tumbling and yields spiking. Unusual actions during times when fears of a recession are growing, where fixed income is typically considered a reliable safe haven. Now, let's just scroll down a little bit here. A market sell-off and rising economic downturn fears would normally cause investors to clamor into bonds for safety, driving yields lower, but that hasn't happened. The iShares 20-year Treasury Bond ETF, or TLT, a proxy for long-term bond prices, is actually down 5% this week. Perhaps even more alarmingly, U.S. Treasury markets are also experiencing an incredibly aggressive sell-off as we go to press, adding to the evidence that they're losing their traditional haven status, said Henry Allen, vice president and macro strategist at Deutsche Bank, in a note. Now, he was saying this was probably in the middle of the night, around midnight, while we were seeing that big move higher in yields that abruptly reversed mysteriously at midnight. Somebody was intervening there. Traders are looking at a number of theories to explain the move, including forced selling by hedge funds, getting margin calls, to more troubling speculation of foreign holders dumping U.S. government bonds. A 10-year bond auction looms later this Wednesday, where the Treasury will seek to sell $39 billion. This follows a 3-year Treasury note auction Tuesday that saw weak demand. The largest holders of Treasuries and potential bidders in these auctions: Japan, China, and the UK, the very countries we have targeted with some of the highest tariffs. So we've got bond auctions, a 10-year auction today, and we had a lousy 3-year auction yesterday. I think tomorrow there's a 30-year auction, and the biggest players in these auctions are our trading partners that we just tariffed. And where do they get the dollars that they're going to loan to us by participating in this Treasury auction? Well, they get it from global trade. Well, if global trade is slowing, where are they going to get the dollars to bid on those Treasuries? Now you can kind of see how the global order has really been just thrown into chaos here. By the way, looks like this headline here just came up. Let's see. This is breaking news here. European Union approves first set of retaliatory tariffs on U.S. imports. This one just broke 10 minutes ago as we were going live here. So Europe is returning fire here. Let's see what they're saying. The European Union on Wednesday voted to approve its first set of retaliatory measures to counter tariffs imposed on the U.S. on steel and aluminum. The European Commission, the bloc's executives arm, said duties would start being collected from April 15th. The response package was unveiled last month, targeting a range of goods. The 27-nation bloc had warned it would act to protect European business and consumers after President Trump's 25% duties on metals. The EU considers U.S. tariffs unjustified and damaging, causing economic harm to both sides, as well as the global economy. The EU has stated its clear preference to find negotiated outcomes with the U.S., which would be balanced and mutually beneficial. All right, so this looks like it's targeted to steel and aluminum. Did I understand that right? Yes, tariffs will be imposed on U.S. steel and aluminum. Does Europe even buy steel and aluminum from the United States? I don't. This seems like very weak sauce to me, to be honest with you. I don't think we sell much steel to the European Union. I could be wrong about that, but this is a retaliation. And the last time we saw some retaliation, the president didn't really take too kindly to that retaliation, did he? No, he definitely did not. Let's talk about this one. China retaliates with 84% tariff on U.S. goods. This one also hitting this morning. China retaliated with an 84% tariff on U.S. goods Wednesday in a further escalation of the trade war between the world's two largest economies. President Donald Trump's 104% levy on Chinese goods took effect at midnight, and Beijing has swiftly responded, increasing its retaliatory tariffs to 84%, up from 34%. From a previous 34%, China's finance ministry said the levies will go into effect Thursday. So, look, we announced our 54% tariffs, and then China said, in retaliation, 34% on the U.S. And then we said, okay, fine, 104%. And then China said 84%. Does this mean we're going to go up another 50 here? Do we have a bidding? Why do we get one of those guys from the cattle auction sections? 34 to the man in the back. 34, do I hear 34? Do I hear 30? Do I hear 54 to the orange man over there? Do I hear 104 from President Xi Jinping over in China? This is getting out of hand really fast here, guys. So the numbers just keep getting bigger. it's essentially a trade embargo now. Somebody was saying that. I think it was Javier Blas over at Bloomberg. He basically said, look, this is a trade embargo at this point. Also, shout out to Spencer Hakimian. Sorry, Spencer, I butchered your name. Spencer H. on Twitter posted this one this morning. He's saying every single small business in the United States that interacts with China is officially on bankruptcy watch. All right, that is a wonderfully doomy kind of headline there, and I'm not sure he's wrong, though. And he's posting this. This looks like a note that came out from some cargo handling company here saying, "Dear customer, in a cargo systems messaging service bulletin published April 8th, 2025 at 6:58 p.m. Eastern Time, U.S. Customs and Border Protection has provided an updated reciprocal tariff rate of duty for goods of China of 113.2%, replacing the previous 34% rate. A modest escalation there, 113%, 113.2. You got to include that 0.2. Look, guys, stuff's going to get more expensive here, and we're not talking a little bit. We're talking a lot of it. So, yeah, get ready for higher prices. That's all I can tell you. Right now, everybody's freaking out over the stock market, or they should be freaking out over the bond market, but everybody's freaking out over asset prices. This has not hit consumers yet. When this hits consumers, it's going to be a mess. Let's just put it that way. Most people, by the way, talk to some people today. Let me know, guys. Send me an email. Talk to some people who don't follow financial markets when you're at work. See what their ideas. Have they heard about tariffs yet? Do they have any idea what's coming? Do they know how big these numbers are? Or are they just, oh, I heard the stock market was heading down, but my guy says buy the dip, and so I'm buying more. I'm curious, what do people who don't follow markets think about what's happening here? Do they even know? I wonder. Fitch knows. Fitch Ratings lowers U.S. retail and consumer product sector outlook to deteriorating. By the way, we have a consumer-based economy. About 2/3 of U.S. GDP is consumers buying crap, mostly made in China. And Fitch just lowered the rating for consumer products. So we got that going for us. How's those GDP numbers looking now? Fitch Ratings has lowered its 2025 outlook for the U.S. retail and consumer product sectors to deteriorating from neutral. The change reflects the expected impact of newly announced tariffs on spending as consumer sentiment moderates and retail costs rise. Most Fitch-rated retailers and consumer product companies have sufficient rating headroom, which should support rating stability through the current volatility. Companies with exposure to discretionary categories could experience negative ratings actions, especially those with limited rating headroom due to recent operating challenges and financial policy decisions, including mergers and acquisitions. Weakening consumer sentiment will pressure retail sales, particularly in discretionary categories like apparel, home and consumer electronics. And the new tariffs will lead to higher consumer prices, further pressuring retail volumes. Some costs are likely to be absorbed by retailers and consumer products manufacturers, which will negatively affect margins. Now, look, one of the reasons that GDP has held up so well for the last couple of years, even though 90% of people have been really struggling with inflation and have seen a decline in their quality of life, is about 10% of people have done really well because stocks have gone to the moon. Assets across the board are going up. Home values went up. Everybody feels richer. So the super wealthy have been consuming like crazy, and it's been driving GDP numbers a lot higher. Well, guess what? That's about to stop because there's no capital gains anymore. The stock market is in free fall. All those asset price appreciation driven consumption by wealthy shoppers is about to go away because there are no longer any capital gains. So yeah, I think Fitch is right to lower this. Besides the fact that things are going to get a lot more expensive, the people who have been doing the shopping just got cut off from their asset price appreciation, so they're not going to have any money to shop with. Meanwhile, Delta pulls their guidance here on Trump tariff uncertainty. Why the stock is rising? The stock wasn't rising the last I looked. Look, we're just going to We'll blow through this one pretty quick, guys. Delta pulled their guidance because there's no way to tell what their business is going to do when tariffs are doing this. There's no way to tell if anybody's going to come over from Europe to go on vacation in the U.S. Probably not. Certainly the Canadians won't. So it's really hard to forecast your business in this environment. I don't think Delta is the last company to do this. I think we're going to see a lot of companies start pulling their guidance That's going to inject a lot of uncertainty and a lot more volatility into this stock market. This is not going to be over in a couple of days, guys. I just want to emphasize that. We're not going to wake up tomorrow and everybody's going to be like, whoo, glad that's over. I'm sure one day we're going to look back on this and laugh. No, this is a global war of economic attrition, and those just don't wrap up in a couple of trading days. By the way, Delta stock, it is higher now. It's actually higher by a lot. It was negative the last I looked, currently higher by about 4.8%. So the market is rewarding Delta for pulling their guidance. That's interesting. All right, now we got to talk about this Microsoft story, guy, because this would be the biggest news in the market if it wasn't for tariffs. And here we are 37 minutes into the show before we even start talking about it. Microsoft backs away from $1 billion data center plans in Licking County, Ohio. Another data center project bites the dust. Guys, the AI bubble is popping on top of the trade war. All right, this insane demand story, it's going away. Microsoft was first to blink in this game of CapEx chicken, just like I said they'd be. And then we got another one here. This is not the same story. This is not the same story as last week. Microsoft has backed out of plans to build data centers in Licking County, Ohio. The company told the Columbus Dispatch that it was no longer moving forward with its previous plans to invest $1 billion in 3 data center campuses in New Albany, Heath, and Hebron. This is the latest in a series of data center project cancellations for Microsoft, with reports recently emerging that the company had pulled back on as much as 2 gigawatts of data center projects across the U.S. and Europe. Shortly after, it was further reported that cancellations also occurred in APAC and the UK. Guys, this bubble is bursting. Pay attention, NVIDIA bros. Microsoft is one of the biggest customers that's been buying those NVIDIA chips to build these data centers. If they're not building the data centers, well, I guess they don't have any need for those chips then, do they? Boy, howdy, there's a reckoning coming in these AI stocks, and it's coming at a time when the market is already in free fall. And by the way, hilarious. This just killed me. The company later added that it will continue to own the land and intends to proceed with the development at some unspecified time in the future. In the meantime, land at 2 of the sites will be kept in a state that allows it to be used for farming. Microsoft is going to be farming. All right. So, yeah, we're going to have, what is his name? Andy Jassy? Is that the CEO of Microsoft? No, I'm sorry, Satya Nadella. We're going to have Satya Nadella in coveralls with a piece of straw hanging out of his mouth, wearing a hat, sitting on the tractor, saying, y'all come back now, you hear, right? That totally normal behavior for Silicon Valley to be planting corn in Ohio. Yeah. What stage, guys? What stage of the bubble are we at when Microsoft decides it's a better investment to plant corn instead of building a data center? Tell me again about that insane demand for these chips. And I just want to add, guys, this is a new data center project cancellation on top of the last one. This is the story from last week that talked about Microsoft backing out from Chicago to Jakarta. And I just want to mention the company recently halted talks or delayed development in Indonesia, the UK, Australia, Illinois, North Dakota, and Wisconsin. All right, Ohio not mentioned there. So the story in data center dynamics, this is in addition to all those projects that Microsoft canceled last week. This is accelerating. All right, and I still have these NVIDIA bros who tell me this is fake news. Microsoft's not pulling their CapEx. Yo, like, what do you guys need to believe that this is happening? Hey, man, number go up. What can I tell you? When you've spent the last 2 years just watching the number go up, it's hard to believe that's going to stop, but it has stopped. And I just want to say thank you so much. Wow, we're 13 deep here. Thank you, Nashville Pasta Man, who says General's House Chicken to be renamed General Don's Oriental Chicken Nugs. Either way, you're still going to be hungry in an hour, Pasta Man. Remember the boat waterfall scene in Jungle Cruise? We're there. Yeah, I referred to this as the Nakatomi roof pattern on X the other day. This is not an orderly sell-off to begin with. Thank you very much, Pasta Man, for supporting the channel and for the laugh, brother. Appreciate that very much. Viv B, thank you for gifting 5 Nobody Special Finance memberships. I appreciate that very much. Guys, if you got one of those, send a shout out to Viv and say thank you. I appreciate that. Welcome to the Melon Heads, and thank you for supporting the channel. We've also got Armando Reyes. Hey, Armando, he says, how much debt in dollars do you think would have to be sent back to the U.S. in order to start causing a problem like making the dollar worthless? So I don't actually think dollar worthless in this scenario is really the most likely outcome. We are seeing the Dixie fall. So we are seeing money move back to Japan and money move back to Europe. Now, what's really going on there, in my opinion, maybe not so much Europe, but certainly Japan, what's happening there is a deleveraging. And one of the reasons why we're not seeing other asset classes rise, this isn't your typical money flows. People aren't pulling money out of stocks and putting them into bonds or pulling money out of bonds and going to commodities. All right, what we're seeing here is a deleveraging. This is money going up in smoke. That's what's happening. Currency is being destroyed because people are being forced liquidated in order to cover debt that they took out to buy these assets. So when that happens, if it happens in a disorderly fashion, you actually get the opposite effect that you're talking about. We could see dollars actually spike dramatically here if this disorderly unwind continues. Because during a mass deleveraging event, it's a scramble for cash and people sell anything and everything they can get their hands on, making currency more rare, making the currency supply fall. And when the supply falls and demand rises, price actually goes up. So the de-dollarization in the long term, I can see what you're talking about here as the world de-dollarizes from global trade and those dollars make their way home. But that's not happening right now. Right now, we're getting a deleveraging. And in a deleveraging, dollars could become very suddenly worth more in that scenario. Now, look, the only other thing I would add, guys, is you can't go back and look at 2021. You can't go back and look at 1987 or 2008. This has never happened before. This is a blowing up of the global order of things, the way we have done trade for the last 50 years. There is no procedure to follow. There is no template or historical example of this. So everybody's just kind of feeling their way around in the dark. Just be careful. That's the only thing I can tell you guys. I don't know how this ends. I don't know where this goes. Anybody pretending they know how this ends or where this goes is full of it. Just be careful, especially on leverage. People who are on leverage right now are at risk of being wiped out. Thank you, Armando, for supporting the channel. Hey, my buddy Travis, Real Estate Mindset, says the Federal Reserve has about $6.7 trillion in assets. Man, things are going great at the Fed, aren't they? What positive impacts would rolling back those assets have? And the effing Fed. Well, Travis, the Fed has been reducing. By the way, good to see you, Travis. Thank you, sir, for supporting the channel. And by the way, guys, check out Real Estate Mindset. That's my buddy Travis over there. The Fed has been doing quantitative tightening for a couple of years right now. So they have been reducing that balance sheet very slowly. I would not be surprised to see that reverse on a dime here. All right. I don't know when it's going to happen here. If this basis trade is really unwinding, if we're getting this sudden, rapid deleveraging and breakdown in the bond market, like so many very intelligent people are fearful of right now, the Fed will turn on a dime and we'll see that that balance sheet asset count start to go up again instead of going down. Now, something tells me because inflation expectations are so high, they won't call it QE. They'll do something like they did when the banks failed in 2023, right? The bank term funding program. Maybe they'll call it like the troubled asset relief program or the paper over other people's losses or the poop L program. I don't know what they're going to call it. They'll come up with some acronym, some special purpose vehicle to try to hide what they're doing, which is really printing money to bail out troubled asset classes. I think we could see that happen pretty quick here. The Fed is resistant to do that now. They came out late last week and they said, we're not going to cut rates. We're going to wait and see what the tariff impact is. But with the bond market blowing up, I think the Fed could be forced to act here. What form that act takes, I really don't know. But Travis, I think the Fed's balance sheet is going to start heading in the other direction, up, not down here. Thank you for supporting the channel, brother. Armando Reyes says, we are seeing 1923, 2000, and 2008 all rolled into one. 1923, I haven't studied that event that closely, so I can't comment on that. 2000, the dot-com bubble? Oh, yeah, the AI bubble. 2008, a housing bubble? Oh, yeah, we got that going on. And let's throw 2020 on there and the dysfunction in the bond market during the COVID hysteria. It looks like we got that going on here. So I'm going to say, at the very least, I can't comment on 23. I just don't know enough about that event. But I can say at the very least, 2000, 2008, and 2020. Absolutely, positively. Thank you very much, Armando Reyes. Good comment, sir. Thank you for supporting the channel. Wally says, we are in the process of a controlled demolition of the current system. I agree with that. We are slowly and methodically, I don't agree with that. This is abruptly and recklessly being corralled into a digital prison. A digital prison. I would say we were heading that way. 2021, 2022 felt like a digital prison. Everybody was afraid to say the word COVID on YouTube in 2020 and 2021. Everybody, in Europe, people are being arrested for social media posts, so they're definitely going that way over there. I'll be honest with you right now. When I see globalism breaking down, and guys, understand this is going to be really painful for a lot of people, but the breakdown in globalism is arguably necessary to prevent that digital prison from happening. That's you could argue that we're doing surgery with a freaking sledgehammer here. Let's not act like what's going on here is like methodical and calculated and very carefully being done. It's not. I don't know that there's any careful, precise way to do this, though. History's being written. I don't know how it's going to turn out, guys. I really don't, but it will be messy. History is messy. Thank you, Wally. I appreciate the super chat, the support of the channel. Jock Mahon says, could U.S. banks be offloading their bonds or a bank run? I don't think banks are offloading their bonds, and I don't necessarily see a bank run yet, at least not retail. We don't see consumers pulling their money out of the banks yet, or at all. I don't want to start one. I'm more leaning towards hedge funds blowing up, or even the broker dealers who take the opposite side of the trade as those hedge funds. I think you're seeing a buildup of counterparty risk in the inner workings of the system, not so much the banks. Mainly the big trading houses and the brokerages on Wall Street. Now, here's the problem. It could spread to the banks. All right. It hasn't yet. But if we get like a Citadel blows up because so many hedge funds go under and they owe so much money to Citadel that they start to have problems, well, then you start worrying about what big banks have credit lines open with Citadel and how much money are they losing yet. It hasn't spread to banks yet. Banks' stocks are not doing so well in this environment. But we're not in a banking situation here yet. I don't want to say too much more on that. I don't want to be accused of trying to start a bank run or anything. But the only other thing I would say, guys, is watch those unrealized losses. Remember the problems of 2023? That was caused by a rapid rise in interest rates that caused bonds prices to fall, and the banks owned a lot of bonds. Well, what's going on right now? A very rapid rise in interest rates causing bond prices to fall. Yeah, the banks are not getting off cheap here. They're not getting off easy, but they're not the source of the problem yet. Thank you very much, Jock Mahon. Sarah Alexander says, thank you for your work. Your thoughts on the direction of residential real estate. Look, I've been saying this for a few years, and I've been wrong about this for a few years. Lower. It's got to be lower. I see blowups in the bond market. Unless the Fed comes in here very soon and starts injecting more capital, if we're seeing U.S. Treasuries break down, if people don't want to hold U.S. Treasuries as collateral, or if people are being forced to sell U.S. Treasuries, then probably the same thing is being done in the MBS market, because just above U.S. Treasuries and the whole counterparty risk thing in the pyramid is mortgage-backed securities. That's like the next level up in collateral and perceived safety. So if Treasuries are selling off, I'm sure MBS is doing the same thing here. Trouble in the MBS market typically means home prices heading lower. Thank you, Sarah Alexander. Appreciate the super chat. Shane Lindquist. What's going on, Shane? He says, good morning, Jack, from Minneapolis, Minnesota. 3-year fan of the show. Thank you so much for sticking with us for 3 years. I appreciate that, Shane. He says, love to tune in every morning. I wonder what's wrong with the economy. Finances chicken wings with Klarna. Yeah, I can pay for lunch in 4 easy installments. Thanks. If only there were signs, right, Shane? He's referring to Klarna cut a deal with DoorDash where you could finance your DoorDash. So you don't want to make your own food. You want to get takeout, but you're too lazy to even drive to the takeout place. So you're going to pay some millennial or Gen Zer to bring it to you. And then you're going to finance it with Klarna. And then Klarna is going to take that financing, package it up into asset-backed securities, rubber stamp it AAA rated at the ratings agencies, and sell it to your pension. Yeah, I wonder what's wrong with the economy, Shane. I just don't know. Oh, my God. How did we get here? How did we get to this point? By the way, Klarna pulled their IPO last week. Klarna is no longer going public. They saw what happened with CoreWeave, and they saw what happened with the tariffs, and they said, nope, watch those private equity firms. They're sitting there holding a lot of bags, all those startups that they bought at bloated valuations in 2021 and 2022, and they can't sell them. They're going to try to park that crap in your pensions. They're going to try to park it in your 401k. Talk to your guy, ask him what you really own, and ask him what they're buying. Just talk to your guy, folks. Understand where your own money is. Thank you, Shane. Appreciate the super chat. Pasta Man is back. He says, Jack, are you doing community service later? I believe he's referring to, will there be a second live stream today? I'm going to have to play that one by ear, Pasta Man. I'm not sure if I'm going to do another live stream or try to get out another video today. If we see something sudden, significant, we will. So TBD. I wish I had a better answer for you on that one, but to be determined, sir. Thanks again for supporting the channel. Grumpa's back. He says, we never exited the 2008 recession. We just papered it over. I agree, Grumpa. He says, we tarped, printed our way out of the symptoms. All GDP growth was government spending. Private GDP has been flat since 2008. Certainly our standard of living has been flat, if not declined. I agree with that wholeheartedly. The only real innovations, information technology has gotten better. Social media has grown, and AI is exciting technology. It's not the bubble everybody else thinks it is, but it is an exciting technology. But really the biggest innovation in the United States for the last 15 years or so has been financial engineering. That's really the only thing we've come up with, and it's been to our detriment. So I agree, Grandpa. Watch that deleveraging, man. We're seeing a very rapid, disorderly deleveraging right now. So all of that is coming undone in a hurry. Welcome, Gary Cronin, a new Melonhead member. Thank you so much, sir, for supporting the channel. I appreciate that very much. And by the way, guys, don't forget our weekly get-together on Zoom every Friday at 2 p.m. Eastern time, where we get together with the magnanimous Melonheads on YouTube. So maybe I'll see you on that one. Links down below, should you feel so inclined. Thank you, Gary. And Richard Bell, buy the dip. What do you think, Jack? Sometimes you buy the dip, and the dip keeps dipping, Richard. And, we saw this. I mentioned this late last week on Twitter when I saw after the tariff announcement, we had Tom Lee goes on CNBC and he says, buy the dip, because that's all he knows how to do, right? Tom Lee is a parrot who has learned to just say the same thing over and over again for several years, and he's been right largely because of printed money. And, well, it didn't work. He had to actually issue an apology. And I tell you, if you listen to Tom Lee on CNBC yesterday, he sounded like he had the wind knocked out of him. He was just, we got this one wrong, guys. I'm really sorry. Like, that was not the same uber bullish Tom Lee I'm used to. I am not a buy the dipper. You may have noticed people who bought the dips got crucified over the last few days. Guys, unless we see some drastic action by the Federal Reserve, I don't see this thing reversing all of a sudden, like on a dime. All right. We're not going to come out of this in a week without papering it over. And right now we're not going to paper it over. And unless everybody decides to give peace a chance, I don't think that's going to happen either. I just don't see this getting better in the short term. All right. So dip buyer, beware. Buy the dip has been the prevailing wisdom for the last 20 years. It works right up until it doesn't. And it stopped working last week. Thank you very much, Richard Bell. Charles G says, can we stop the Fed from making these programs so they can stop bailing out the banks? That would require an act of Congress, Charles. And let me just say, what they did in 2020 was already illegal. The Federal Reserve Act does not allow them to create special purpose vehicles to buy up corporate bonds and ETFs. And they did it anyway. So they've already been allowed to break the law. A whole bunch of them got caught insider trading right before that happened. They investigated themselves and found no wrongdoing. They were able to retire and keep all the money they made. So can we stop them? Probably not. Probably not, Charles. All you can do is choose not to participate in their system. That's really the only way you can stop them from affecting you directly. But even then, the consumer prices, everything, your home, your car, everything else is going to be affected by what they do. So right now, there is no stopping that behemoth. They're going to do whatever they want to do. Nobody can stop it. Congress isn't going to get together and decide to repeal the Federal Reserve Act. That's for sure. They can't agree on what time it is. Thank you very much, Charles G, for supporting the channel. Financial Maintenance says, Jack, hit it. Tariffs starting dollar milkshake. Well, that could be. Shout out to Brent Johnson and the dollar milkshake theory. Right now, the Dixie's heading lower. So far, we're not milkshaking. Not yet, anyway. It could. If this deleveraging really picks up steam and if people start blowing up and basis trades start falling apart and yields continue spiking, we could see a big spike in the Dixie on that. Right now, we're not seeing it. There's too much money going back to Europe and Japan right now. It's dragging the Dixie lower. So far, no milkshake. So far. But that's in play here. Absolutely. Shout out to Brett Johnson once again. And thank you, Financial Maintenance, for supporting the channel. T.A. Chapman gifted 10 Nobody Special Finance memberships. Thank you, T.A. Hey, guys, while you're thanking Viv, also thank T.A. Chapman. If you got one of those, welcome to the Melonheads. Thank you so much, sir, for supporting the channel. I appreciate that very much. Thank you guys so much for your generosity this morning. I really appreciate that. Thank you, guys. Look, it's mayhem out there. Be careful on leverage. It's the only thing I can tell you guys. Don't know where we're going. Don't know what's going on. Just be careful. That's the best thing I can tell you right now. Thank you so much for the generosity. Thank you guys for joining us. Don't forget that like button and the subscribe button on the way out. Also, links down below to Patreon, YouTube memberships, all that good stuff, should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. And everybody, until next time, live small and dream big.